Good morning and welcome this morning to Introduction to Cryptocurrency, another great webcast from Schwab Coaching. This is lesson 2 of a 4-part series, which hopefully will be extended to a more-part series as we get deeper into the workings of cryptocurrency. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Jim Ferrioli, who is the director of cryptocurrency research at Charles Schwab, and he is going to be our expert today. We're going to take a look at today, how does cryptocurrency work, and some of the characteristics of the blockchain, some of the characteristics of things like cryptocurrency wallets, and we're going to be exploring the difference between proof of work and proof of stake, something that we talked a little bit about last week. And at the end of the discussion today, we will talk a bit about some ways that investors can gain exposure to cryptocurrency through stocks that have exposure to cryptocurrency. Now, this will be recorded, as was last week's webcast. We will be posting that recording as soon as that recording has completed a review process, so it should be fairly quick. But that being said, I'll also show you where there are some resources to learn more, not only about these particular webcasts that focus on an introduction to cryptocurrency, but also other webcasts that talk about trading and investing and understanding things like the Thinkorswim desktop software platform. So I'll give you those resources as well. So welcome to all of you that are here with us. I'm also joined out in the chat by my good friend Connie Hill, 20 plus year veteran of the financial markets. She is there to help facilitate your questions along the way. Now, remember, for those of you that might be brand new to this environment and to these webcasts, we can't talk about your individual accounts, nor can we talk specifically about trading cryptocurrency yet, but we're hoping to get there as we get into later episodes of this particular webcast series. But we'll get started here as we do that. Just a couple of quick housekeeping items, then I will introduce you to Jim, and we'll have a nice little back and forth conversation about some of the characteristics and basics of cryptocurrency. So, a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. Nothing should be construed as any kind of a recommendation or solicitation of a particular type of trading, a particular account, a particular strategy, or any particular securities or symbols. Now, as we go through this discussion, it is important to remember that past performance is no guarantee of future results. Investing does involve risk, and in fact, digital currencies such as Bitcoin, that we will talk about in this discussion, are highly volatile. They are not backed by any central bank or government. That is part of their attraction for some investors. But digital currencies lack many of the regulations and consumer protections that legal tender currencies and regulated securities have. Because of that, they are considered to be a speculative instrument, and there may be additional risks associated with those. So we'll show you where you can also get more information about that. Cryptocurrency related products carry a substantial level of risk. They are not suitable for all investors. Make sure you understand that before considering any cryptocurrency type of transaction, including instruments like individual stocks that have a high level of exposure to cryptocurrency. We'll get into some of the details in later episodes about some of the offerings that are available via the Thinkorswim platform and elsewhere. Cryptocurrencies, though, that cryptocurrency market data and other information is provided by third-party vendors of information. And anytime you see information from an industry or from any other third party, remember that the opinions of those third parties are their own. Now, when we talk about the technology relating to digital assets, including blockchain, it is new, it is developing. That's one of the attractions for investors, but it's also one of those things that brings about some of that risk. So as those things change, regulations change, legislation changes, the environment around which we view cryptocurrency may change as well. Now, to do some of those things that we're going to talk about today, like viewing individual symbols that have exposure to cryptocurrency, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. Great learning environment, not a guarantee of future success out there in the real world. Now, as we get into more of this discussion, remember, for the sake of simplicity, the examples in this presentation, if we look at any specific trades here, those don't take into consideration things like commissions and transaction costs. All of those things are things that you need to pay attention to as you continue to trade. So now that we have that understanding of those basics, the housekeeping items as well, let me just give you a real quick tease of what we're going to do. Last week we talked about what is a cryptocurrency, or what is cryptocurrency just kind of as a general category. Today we're going to dig a little bit more into the nuts and bolts of how does cryptocurrency work. Next week we're going to talk about how do people get exposure to cryptocurrency. We're going to extend what we're going to do at the end of this discussion today. And then we're going to talk about what forces might drive cryptocurrency prices, because sometimes they move the way that you expect them to move, sometimes they move differently than you expect them to move. And boy, there's a whole lot of noise out there. So, Jim, hopefully, maybe we can get some clarity and cut through and add some signal to that noise. Let me introduce my friend Jim Ferrioli, Director of Cryptocurrency Research here at Charles Schwab. Jim, welcome.
Hey, Ben, thanks for having me on again.
Yeah, you bet. So we started last week by talking about what is a cryptocurrency, or what is cryptocurrency. Today, our focus is going to be on kind of understanding the mechanics and the nuts and bolts. We're going to spend a little bit of time talking about blockchain. We're going to talk a little bit about this concept that makes some of the cryptocurrency instruments a little bit different. Proof of work versus proof of stake, and how that translates into things like those rewards that we talked about. This is an area that I think, though, is going to be very interesting to many potential investors and traders of cryptocurrency, and that is this idea of where does it sit? Where does it exist? Where is this cryptocurrency stuff that we're talking about? What are these things called wallets? Do I need to go out and get rid of that Velcro wallet that I've had since 1984 and put my cryptocurrency in it? And we'll talk a little bit about companies that gain or that have exposure to cryptocurrency. So let's talk this concept, Jim, of crypto and blockchain. We talked a little bit about the basics of that last week. We learned some of the terms. Let's kind of unpack this idea of what actually happens in a blockchain transaction. And with that, maybe for somebody that's new to crypto, maybe what's the simplest mental model to understand this idea of a blockchain?
Sure, sounds good. So if you think of
Yep. Go ahead.
If you think about a blockchain transaction, what are we doing here? You have one user who's sending funds to another user on a blockchain network. And so all a transaction is sending a message. And what that message has in it is instructions. So as an example, I have in a wallet a series of private keys. On the blockchain, there are different public keys. These are called addresses. And so if you have the correct private key, you can access what's stored at a public key address. And so that's why we refer to the pieces of hardware or software where we keep our private keys as wallets. What happens is every 10 minutes or so, a group of users on this blockchain, specifically in this case, the Bitcoin blockchain, they race to solve a code and create a new block of transactions. And so what essentially we're doing, we're creating a record of transactions that serves as a public ledger And the process for Bitcoin of maintaining this blockchain is called mining. And it's designed to be secure, transparent, and accurate. And one of the things that's interesting about it is there's no central authority that approves transactions. And that's the benefit of having a decentralized, independent network. It's not dependent on any central monetary authority. But there are drawbacks to that. If you send money to the wrong address, it's gone forever, or it could be gone forever unless you by happen to know the person who owns that address. And so there are risks involved too. But ultimately, that's what we're doing. It's a historical record of transactions. Every previous transaction is in the most latest block. So you're quite literally chaining blocks of transactions together, one after another. And every single user on this network that's maintaining and the historical transaction is every single block has every single previous transaction. And so that's where the idea of a consensus mechanism comes in. When a miner is submitting proof, they say, I've solved the algorithm. This is the correct version of the blockchain. Every other node on this network can verify, yes, what they're submitting matches the correct historical record. And in that case, if they're the first person or entity or node, which we refer to them as, to validate the most recent block, they're rewarded cryptocurrency for their work.
So Jim, what has to happen in order for that validation to occur and for the network to recognize that transaction has been recorded? What's the mechanism that makes that connection?
Yeah, so for the Bitcoin blockchain, we refer to this as proof of work. And every 10 minutes, when a new block is being validated, and a block consists of the previous 10 minutes or so of transactions, these miners race against each other to try and solve a hashing algorithm. And the way that the Bitcoin blockchain maintains a 10-minute validation is it makes the algorithm that they're racing to solve either a little bit more difficult or a little bit more easy, depending on how many miners are on the network. And so by doing that, it can, over time, make sure that blocks are more or less mined every 10 minutes. If there's a lot of miners on the network, prices are really racing, they're off to highs, so there's a lot of incentive to be earning these rewards. It will make it a little more difficult to solve this algorithm. Again, so that's how it maintains itself over time. But so the rewards are essentially validation, for validation of the blockchain. They're given to miners, and they're used to encourage nodes on the blockchain to use their computing power for good, instead of trying to do adverse activities, maybe censor previous transactions or steal any funds. If you have enough resources, you're incentivized to just use them for the good of the blockchain and just earn rewards. And so again, there's two different ways of doing this: proof of work, which we talked about, which is something like Bitcoin uses, and then proof of stake. That's a little bit less energy intensive, and blockchains like Ethereum use that. And the proof of stake is a bit different. And what they do is, if you're a validator on that block, you essentially put some of your personal holdings in an escrow account, and then you put forth the correct version of the blockchain. If it is true that you are maintaining the accurate version, you are rewarded with new cryptocurrency. However, if you are being dishonest, the cryptocurrency you put in escrow is taken from you. So again, it encourages honest behavior on a decentralized network where there's no central authority to maintain it.
So Jim, that brings up a question in and of itself then. Really two questions. One, given the fact that the ledger contains all of that transactional data, how big does that data file get? Number one. And number two, if there's no centralized authority to oversee things, then how does that prevent a bad actor? I mean, I get the idea of incentivizing through putting in an escrow account, but who in proof of stake, but who then says, okay, we're going to withdraw that escrow account and take away your cryptocurrency that you put up as your stake? if you're a bad actor in validating transactions?
Yeah, and so great question. So, in terms of the blockchain size, it's quite large. But one of the things people don't realize is it's not large enough to maintain the entire global financial system, and it never
Okay.
will be. This is for Bitcoin specifically. Um, in terms of who actually validates it, what happens is whether you're a miner or a validator on a staking protocol such as Ethereum, it's you put forward to the entire blockchain network what you're approving. And so it really is decentralized. Any node on the network that's actively working to validate transactions, they're comparing their work. Now, this is all automated through computers, to be clear. There's not an individual person, kind of
Sure.
checking the box here, like, okay, this checks. But it's broadly decentralized across every single validator on the network. And that's one of the important things to point out. Just because you're a validator on the network, you may be an individual who's running a node from your home. You probably don't have enough computing power to ever actually earn any blockchain rewards, but you still are contributing to the validation there. And so, these networks are designed so that it's very difficult for an individual or a group of individuals to really be able to take over control of the network, because there's always that fallback where you do have individuals and smaller participants on the network that are validating for the sake of validating.
Interesting. Okay, so let me ask you this, because I know we talked a little bit about this, the concept of fiat currency, and we all have kind of this general arrangement and agreement. That's the idea behind fiat, that a piece of paper has a representation of value. Is there a fiat element to the blockchain in that we have just kind of this general recognition that if the chain has been validated, everything that's gone before on the chain is true and correct? Is it kind of like that shortcut of saying, okay, I know on if I'm verifying my identity to some place that has I've already logged into, I maybe just have to use the last four digits of a recognizable number, and it uses that as a shortcut. Is there a shortcut on the blockchain that's used as a fiat?
So the thing about when comparing blockchain cryptocurrencies to kind of traditional currencies is you hear this term fiat thrown around a lot. And so to dive into that concept a bit, when people refer to a fiat currency, and I'll use the US dollar as an example, it's backed by the full faith of the US government. If the government needs to meet its obligations, they can quite literally print new money and meet them. And so the reason people use this term fiat to describe many traditional currencies nowadays, because 50 or so years ago, currencies were backed by gold. And so breaking away from that gold back, a hard asset denominated currency, has made way to this idea that traditional currencies are backed by nothing but a promise. So cryptocurrencies are a bit unique. And so again, this goes back to the proof of work, proof of stake concept. For a cryptocurrency like Bitcoin, Bitcoin is backed by proof of work. To
Right.
maintain the Bitcoin blockchain is exorbitantly expensive. There are real energy costs associated with validating the blockchain. So if you're a Bitcoin miner, you essentially have two costs. You have your fixed cost, which is your hardware, and then you have your variable cost, which is your energy. Energy prices can rise and fall based on whatever else is happening on the electrical grid, however many miners are on the network at that time. And again, so it's backed by physical energy. But the real reason, and because this shifts to proof of stake blockchains aren't backed by energy, they're backed by a broad decentralized consensus. Many of them are considered disinflationary currencies. Bitcoin as well is a disinflationary currency. And so these are more additional reasons why some crypto investors refer to cryptocurrencies as non-fiat, because they don't have inflationary supplies compared to traditional government circulated currencies, which have infinite supplies. But it's important to point this out that not all cryptocurrencies have disinflationary growth. There are many inflationary cryptocurrencies. And so that's an important thing to consider when you're investing in them. Ethereum specifically does have an inflationary growth rate. So they use a mechanism called burning, which means they take Ether, part of every single transaction, and they send it to a non-recoverable address. So it essentially pulls it out of circulation. And that's their way of kind of maintaining a quasi-disinflationary circulating growth rate.
And the reason, and that works with Ethereum, the reason that Bitcoin has a disinflationary component to it is because there is a finite number, or theoretically, a finite number of Bitcoin to be mined. And as the process approaches that finite limit of those Bitcoin, that hash rate decreases, correct? The rate at which those transactions can be solved decreases, so it requires more and more effort to create those Bitcoin, correct?
So what happens is, yes, so there's 21 million ever Bitcoin that can ever be mined. And the last Bitcoin that will ever be mined will be in the year 2140. Now, every 4 years, the amount of Bitcoin that's rewarded to miners is reduced by 50%. And so that's where the disinflationary growth comes from. The forward new supply will always be less than the current new supply. Every 4 years, we know that rewards can happen. And then eventually, there is only a 21 million cap. About 20 million Bitcoin have already been mined, and there's estimates that anywhere from 4 to 6 million are lost forever. And so it's a supply constrained asset. But to your point about the cost, so because the amount of new Bitcoin that can be produced every 4 years is reduced in half, the cost of maintaining the network essentially doubles every 4 years. And so it gets more expensive over time to maintain the network, and that actually makes it more secure. For a much smaller network, if you were a large entity with a lot of capital or energy available, maybe a sovereign country, you could theoretically try to take over a network. For a network as big as Bitcoin, it would be so prohibitively expensive, not to mention it would take years to actually procure the equipment you need, that it's really not possible. So again, the bigger a proof of work network grows, the more expensive it gets to maintain, the more secure it actually becomes. And so it's a net positive.
Okay. All right. So that helps us to understand this, the difference between proof of work, proof of stake, why cryptocurrency behaves the way it does relative to the blockchain. Now, Jim, let's kind of, and we're not done digging into that. In later sessions of this webcast, we will dig deeper into some of those other aspects of mining and exposure, the companies that have exposure to that. But now let's talk about this aspect, which is an important consideration. We talked about it at the very beginning, is where is my cryptocurrency? Where does it exist?
Yeah, so this is kind of one of the areas that people that are new to crypto investing get tripped up. You hear the term wallet, you think about the leather, thing you hold in your pocket that's got your cash and some credit cards in it. And it was named that for a reason. It was the idea to take kind of a hard to wrap your head concept around and put it in something you understand. And so what a crypto wallet is, it's a place where you store public and private keys that you own. The actual cryptocurrencies, they live within the blockchain networks that they're built on top of, and they never leave those networks. So what your private keys and public keys give you access to is the cryptocurrency stored on that network. And so if you want an example, if you think about it, a public key is kind of like your email address. I can send Ben an email. He can send me an email. As long as you know my email, you can send me email. You can't access my own email, though, without my password. And so my password in this example is similar to a private key. And so you can see all the public addresses out there. And the key thing that grants you access versus other people is your private key. And so that will actually grant you access to interact with funds that are stored there.
So this is important. This idea of having a wallet is important because it gives, again, that investor or trader that wants to gain exposure directly to cryptocurrency or wants to hold cryptocurrency directly, a way to keep it, right? Keep it safe, keep it accessible so that it can be used either to, convert into something else or to sell or to buy and add to a portfolio. The wallet is that central repository, how it gets housed, right?
Correct. Yeah. So cryptocurrencies, we don't have bank accounts for them.
Yep.
If you buy cryptocurrencies, it's not like buying a foreign currency or a stock or a bond. It just can't go to your brokerage account or your savings account. And so wallets are where you store cryptocurrencies. And there's different types. There's hot wallets, there's cold wallets, and there's different levels of security and convenience that come with those. Everything's on a scale. And ultimately, you have to figure out what works best for you. So as an example, a hot wallet is a wallet that's lives on maybe a website or a crypto exchange. And so it's a bit lower security because it's always connected to the network. It's much more convenient if you're an active trader and you want to get in there and have access to your funds maybe on a daily basis or a more frequent basis. A cold wallet is the complete opposite. Often these are pieces of hardware. And so it's something that you actually have to keep and store. So they're very secure. They're not connected to the blockchain network unless you physically connect it, but they're much less convenient because anytime you want to trade or invest or sell something you own, you have to then access it. There's also considerations in terms of estate planning. If you pass on and you have funds in a cold wallet, unless you have some sort of directive in your will, it may be unclear what happens with those. And even if you do have a directive in your will, if your descendants don't have a way to access that cold wallet, they could be locked out. And so again, there's balances between hot and cold. And warm wallets are kind of, they take elements of both of these different wallets. And then when you think about custodial and self-custodial wallets, again, a hot wallet is more of a custodial wallet. You're using that at an exchange. Someone else is custodying it for you. If you are managing your assets in a cold wallet, you're doing self-custody. It's very secure. It's less convenient, and there are risks. Akin to if you hide your gold bars under your mattress, and then you forget where you put them. So it's the same kind of concept.
Interesting, because I think that is a good analogy for that. Is that when you self-custody, you take those responsibilities. So these are some of the things to consider when protecting crypto wallets, aren't they? Right? Passwords, the authentication process. Where, if it's a cold wallet, where do you put that? I mean, you could drop it out of your a cold wallet USB key out of your pocket and run over it with your car, and now that's lost. Or the famous example is the guy that had crypto or had Bitcoin in a cold wallet on a hard drive and threw the hard drive away, and now had to go out and buy the landfill where that hard drive might be, and he's digging through it piece by piece to try to find it.
Yeah, you should treat your wallet the same way you would treat any other secure piece of information. So strong passwords, two-factor authorizations, anything that you would want to protect access to a bank account, you would theoretically want to protect access to a hot wallet. And then you certainly have to think about, if you're using a cold wallet, what you're doing. Safe deposit boxes, a safe, somewhere where it's storable, but easy enough to access if you need access to it. And so if you think about it, there's, again, you have what we talked about from hot wallets and cold wallets, you're balancing kind of security and convenience. There's other kind of, there's trade-offs from security measures as well. So password and an SMS or an email two-factor authorization, it's relatively easy. That's kind of how every application works these days. And it's just like a basic offense. A multi-signature cold wallet, that's something that often institutional custody agents will use. That requires a physical piece of hardware to access your keys, and then multiple users to actually approve getting access to it. So there's a scale in terms of complexity and how secure they are. And again, you have to kind of look through the different options and find what's best for you. There's no single
Sure.
solution that's right for everyone. And so again, you should understand what the options are, and ultimately what you think is most appropriate for your level of comfort with cryptocurrencies, how often you think you're going to be investing or trading or
Right.
anything like that.
Well, and this is another area in reference to some of the questions that are coming out in the chat, Jim, where legislation is evolving and developing around wallet storage and cryptocurrency storage and blockchain access, as is legal case law being developed. One of the questions was, is there any law or legislation that protects against somebody stealing, say, for instance, a seed phrase as an access component to a wallet? And how do you prosecute them if they do that? And how do you know that something like that's happened? I mean, that is one of the concerns, I think, that investors that are new to this concept of cryptocurrency, and it's absolutely a valid question to ask, how are these laws evolving?
It's really important. And so if you think about, maybe more mainstream areas where you can transact in cryptocurrencies, and we'll use Schwab as an example, right? Schwab launched crypto trading earlier this year. There's clear KYC ownership tied to your crypto account. And so there's something that you can prove, that was my cryptocurrency. If you can find the person who stole it or accessed it, there's potential that they could face legal consequences. But this is also one of the risks with cryptocurrencies. I mean, we have seen hacks on different blockchain networks, and often the funds can be unrecoverable. And so it's something to consider when you're investing. This is a new area. As it's gotten more mature, the security around these protocols has improved as well.
Mm-hmm.
And that's one of the key things that traditional financial institutions that actually waited to get involved in this space, it's not that they didn't want to meet their customers where they were and give them access to investments they were interested in. And it's, how do you solve these things? How do you create an environment that's safe and relatively secure for clients who are looking to store assets that are unlike any other asset a financial institution holds on their balance sheet? And so these are important things to follow. And the case law is evolving. As it becomes more mature, we are seeing situations of legal cases being brought. And these can create kind of a path of, how we should think about this as the space evolves more. It can create jurisprudence and legal precedent regarding to rulings as they come. But it's an evolving space for sure.
Yeah, and I think one of the other areas that's also evolving is how cryptocurrencies and specifically certain types of coins and certain types of crypto instruments get used. Only one of those use cases is the idea of, okay, I have a certain amount of, let's say in this example, Bitcoin. How do I buy groceries with that Bitcoin, right? How do I translate this currency into the currency that's accepted at my grocery store, which is US dollars, right? And what's the rail that takes that storehouse of value in cryptocurrency and turns it into a transactable, fungible currency that can be used in exchange for goods and services, right?
Yeah, 100%. And that's a rapidly growing space. There's many fintech companies that are now kind of operating in the intersection of kind of the digital assets, cryptocurrency world and the traditional finance world. And they're looking to say, how do we actually bridge these two so that you can conveniently use them in everyday use cases, as opposed to just storing them or solely interacting on a blockchain network?
So, one of the things that we're going to talk about throughout this series, Jim, is the idea of how do we gain exposure to cryptocurrency in a portfolio. We talked a little bit last week about some of the ways that are available to gain that exposure via direct investment in crypto, right? Either through futures or through individual, trading the spot currency. We touched on a little bit the idea um, of the different types of coins that can be purchased through different ways, buying that spot currency. One other way to accomplish the goal, if the goal is to use cryptocurrency, for instance, as an asset that moves differently than something else, right? Which is the element of, or the essentials of a diversified portfolio. You have things that move in different fashions. One of the ways that investors can do that is by buying and selling shares of companies that have large amounts of cryptocurrency exposure. And so we've got some of those listed here. This list is by no means exhaustive, nor mutually exclusive, nor is it complete by any means. There are many, many, many companies, some that you wouldn't expect, that have exposure or have storehouses of cryptocurrency on their balance sheets, and that provides risk but also opportunity. Yes.
Yes, there's lots of different crypto stocks. And again, just to echo some of Ben's comments, none of these listed here should be perceived as a recommendation to invest in any of these. This is solely informational. But if we think of kind of the four different categories
Uh-huh.
of crypto stocks, and again, it's very broad. You have what are called corporate treasuries or digital asset treasury companies. And so these are publicly traded stocks that acquire cryptocurrencies on their balance sheet. And there's different strategies they use to do this. Some of them may issue common shares, some of them may issue preferred shares, and some of them may have their own ways of acquiring Bitcoin as well. And some might have kind of diversified approaches where they also mine Bitcoin. And so there's all sorts of ways that you could acquire Bitcoin on your balance sheet. But so for these types of companies, their core focus is solely acquiring cryptocurrencies on their balance sheet. They don't have another business, another operating line. They're solely function to acquire cryptocurrencies. Now, a bit different, you have companies that are involved in either providing cryptocurrency services or infrastructure. And so Coinbase Global is a US listed cryptocurrency exchange. Investors who have historically wanted to buy or sell different cryptocurrencies could do that on Coinbase. Mara Holdings is the largest Bitcoin miner that's publicly traded. And so again, it's a different type of exposure. This is a company that's directly involved in validating the blockchain. They earn cryptocurrency by putting forward the correct version of the blockchain and being rewarded for it. And so it's a different way to gain that exposure. And then you have companies like Galaxy Digital. This is a financial institution focused on institutional asset management, trading, and digital asset services. And so again, it's a different type of exposure than these other cryptocurrencies. And so the one thing that I'd like to point out is almost all of these types of companies have very high correlations to the underlying cryptocurrencies they're associated with. At times, they can kind of serve as levered proxies on that cryptocurrency, but cryptocurrencies are extremely volatile, and these are even more volatile. But one of the biggest trends we've seen in kind of more of the service provider space, and so think of something like Galaxy Digital or Coinbase, is over time, these companies, to grow their businesses, have tried to add on products and services that make them a bit less correlated to simply the moves in Bitcoin. And so again, when you think about your exposures, you should think about what these companies are actually doing.
And then we have companies that maybe are a bit surprising, but maybe not so much when you start to think about it, that have some exposure to cryptocurrency, like Tesla or Block, which used to be Square. You have PayPal or Nvidia, for instance, that have exposure to the cryptocurrency space as well, right?
So yeah, I'm glad you brought that up. There are some companies, right? So Tesla, most people on this webcast are probably very familiar with what Tesla is. They produce electric vehicles. They're getting into robotics, but they do own some Bitcoin on their balance sheet. But the things we would point out for something like Tesla is the amount of Bitcoin they hold on their balance sheet is very modest relative to what drives the actual company. And so I wouldn't really consider that a Bitcoin proxy, but we do think it's interesting that companies are using cryptocurrencies as sort of a dynamic treasury for some of their cash.
Sure.
You have companies like Square. We were talking about these fintech companies that are trying to sit in the middle between the traditional financial world and the digital asset world and bridge the two. How do you transact with cryptocurrencies? And so Square manages a service that does that. They also produce their own ASICs for Bitcoin mining. And so again, they have Bitcoin exposure. And sometimes for companies like Square, if there's a big bid happening in cryptocurrencies, you'll actually see, these companies get rewarded for having that association. And so there's all sorts of different crypto stocks, and again, each one, what they do is a little bit different. So if you're thinking
Sure.
of just investing in crypto stocks, you should make sure to understand what its drivers are, because not all of them are just going to act as levered proxies to the cryptocurrencies they track.
So while you've been talking, Jim, I've been showing the Thinkorswim desktop software platform, and I've got just a quick comparison chart. So the purple line that I've got here on this chart, and again, remember, these are simply illustrative examples, but the purple line that I've got on here is a comparison tool. I'm just using /BTC, and that is the Bitcoin futures continuous contract. That's going to be fairly close to spot crypto prices, but behaves a little bit differently because it has its own forces of supply and demand. And I've got that overlaid against some of these stocks that we've been talking about in terms of their performance. So here's an example. This is Nvidia, where they have exposure to not only Bitcoin holdings themselves, but also exposure to the tools needed to mine Bitcoin. In fact, they make GPU chips that are used in crypto mining. So they have some sensitivity to that price. When the price of Bitcoin goes up, demand for those GPUs goes up, but they also have lots and lots and lots of other forces at work driving their movement. But the one that we talked about, for instance, that maybe has a little bit more direct might be Strategy, which is that direct holder of crypto. And you can see the stronger correlation here between the price of the stock, MSTR is the symbol here, versus that cryptocurrency or the Bitcoin future in this particular case.
Yeah, if I could point one thing out, and it's actually very interesting. So NVIDIA chips, you actually can't mine Bitcoin with them anymore. You have to use ASICs instead of GPUs.
Uh-huh.
But the past several years, there's still been a very high correlation between Bitcoin and NVIDIA, which has led a lot of investors to still kind of maintain that relationship. And
Yep.
so that's another thing to consider is that, sometimes Bitcoin trades in a high correlation to just technology stocks broadly. In the past few years, we've seen a high correlation to a lot of these AI and software names. And so what is over the long term a low correlation asset, it's important to understand the short term what it's correlated to, because that can have an impact on its price. Even if it really doesn't have a fundamental reason why it should be trading with NVIDIA, it's showing correlation, it's in kind of that high momentum bucket, and investors decide to start selling the momentum factor, it's likely going to get impacted as well.
Absolutely. Jim, I tell you what, our time goes so fast when we do these webcasts. I wish we had more time, but I want to give people some resources that they can go to. I'm at youtube.com/at Trader Talks webcast. This is the repository, if you will. This is the hot wallet of all of the Trader Talks webcasts that is publicly available. Investors, traders, attendees can get access to these webcasts and learn more. And you can simply search for the word, as I've done here, cryptocurrency. You see the one that we recorded last week. You can see other webcasts that talk about, and in fact, I talk about it quite often in my Trading Futures webcast, where we talk about some of that exposure to cryptocurrency and various other scenarios. You've done a series of short videos regarding Cryptocurrency Basics. So these are some great resources. All we ask investors and attendees to do when they come to look at these and watch these webcasts here on YouTube, just click on that subscribe button. It makes it easier for them to find that information. So, Jim, as we pop back over here really quickly and as we wind this up for another week, just a quick reminder, we talked about blockchain basics, proof of work versus proof of stake, wallets and companies with cryptocurrency exposure. And as we go forward next week, we're going to talk a little bit more about this process of gaining exposure to cryptocurrency. So my thanks to you, Jim, for being here and giving us some great information about the introduction and basics of cryptocurrency. And thanks to all of you and Connie for helping out, our great production staff and our reviewers. And we'll talk to you again next Monday for more cryptocurrency information. Take care, everybody. Bye-bye.